Another month, another 3 months on sale episode, this time for the month of May 2023. Let's get into it. What's up, everyone? My name is Ale. Welcome back to my world of stocks. In this month's episode, we're actually going to switch things up a little bit. We're going to do it a little different. Now, normally I would pick one low risk, one medium risk, and one high risk option just to add a little more variety to the episode. But this month, I'm actually going to crank up the risk meter just a little bit higher. We're going to swap out the low risk. We'll keep the medium risk, and we're going to add on an extra high risk. So it's going to be 0 low risk, 1 medium risk, and 2 high risk stocks that we'll be talking about. And the reason for that is because I just feel that I'm seeing more higher risk stocks really crashing hard right now because of the macro economy and the environment. And I feel that a lot of these have a lot of turnaround potential over the longer term, because it's not so much that they have company specific issues, but rather that I feel the macro environment is really causing them to crash. And because of that, I do think that they have turnaround potential for the longer term. But again, these are going to be higher risks. So please do your own research, make your own decisions. Don't ever just copy anything I'm doing. I'm only sharing my opinion, and these are stocks that I happen to be interested in buying right now. I'm actively buying them in small amounts, slowly over time. But again, make your own decisions, guys. This is just my opinion. But if you're still with me, let's go ahead and not waste any more time. Let's jump straight into this list. Can't wait to share what these are and talk to you more about them. Okay, let's start first with the only medium risk option this month. And right now, I continue to see the pharmacy retail giant Walgreens Boots Alliance, ticker symbol WBA, getting crushed, and I just think it's a steal at these prices. Now, if you guys know one thing about me, it's that I like to buy more of a stock when I'm actually down on that position, and it just so happens that Walgreens is one of the few stocks in my portfolio that I'm currently down on at over 3% negative on my position, so I just think it's time to buy more. Guys, the stock is now trading for the lowest prices we've seen in over a decade. This used to be a $100 stock and is now just around 30 bucks a share, and it could be headed even lower, but the more it falls, the more attractive it gets, as it's now yielding also the largest dividend in probably their entire history at a mouth-watering over 6% yield. And by the way, that history is no joke either, as they're almost classified as a dividend king with nearly 5 decades of consecutive growth, and yet it still has a good payout ratio below 50% too. What's not to like about that? Well, the negative part of the story, I would say, is that as more of a legacy player in the pharmacy retail space, Walgreens has struggled to grow their business over the past decade, and while the pandemic was kind of what they needed to get more customers through their doors that wanted the V shot for the pepperoni, as well as stocking up on any medicine that they could get their hands on, the fact is that they're now having to lap those years of unusually high growth, which is why their profits fell by over 20% last quarter, which management blamed almost entirely on lower demand for pepperoni shots and tests. However, things are not as dire as they might seem, at least in my opinion, because sales still rose by over 3% despite the horrible conditions, which is expected to sustain at that level throughout the full year and even increase up to 5% growth next year as well. Keep in mind, guys, this is a giant corporation already doing over $130 billion in sales. The biggest issue right now, though, is their profitability, and that's why investors are panicking. However, I believe that Walgreens is actually doing a great job of diversifying into primary care through their acquisitions of VillageMD to synergize their stores into clinics, as well as the $9 billion purchase of Summit Health, which was the largest physician deal in all of last year. And it's going to take some time to turn the profitability ship around, and these business restructurings will likely be an added drag for a bit longer, but I also think that the moves will improve their cash flows and their margins over time. And in the meantime, you get one of the best dividend payers in the market for a price that is not only over 60% cheaper than the sector on an adjusted PE basis, but that is also significantly lower than even the most bearish analyst price targets as well. Again, it's not without risk. They're obviously in a turnaround phase right now, but I'd be very surprised if the stock continues to trade this low for much longer. I really feel that the only reason it's being kept at these levels is because of that macroeconomy issues and the fear of recession. But if we can move past that, I think over the longer term, there's no way that that dividend should be yielding this high. I think it's going to have to correct for that, and I would imagine that the stock price increases because of it. That's going to bring me to the second stock, and this will be the first of the two high risk options. And for these ones, it's kind of a similar situation, but because we're cranking up the risk, we're actually going to go over to the financial sector where a lot of stocks have been getting absolutely destroyed. And the first of those two that we're going to talk about today, first of those is going to be one of America's top 5 largest banks in US Bancorp, ticker symbol USB, which, by the way, is the newest stock that I've recently added to my portfolio. And just like Walgreens, I am also currently down on my position, down over 5% to be exact. But the more that it falls, I think the more interesting and attractive it gets. US Bank is, of course, another casualty from all the selling pressure in the financial sector because of the recent collapse of a few large banks, notably Silicon Valley Bank and Signature Bank. However, that's despite the fact that US Bank has barely any similarities to how those riskier banks were being run. And not just that, but USB also reported earnings recently, and I actually really liked what I saw. In fact, not only does the run on Silicon Valley Bank appear to not be spreading over to the giants, but instead, it looks as though they might even be gaining customers as people try to move their funds over to larger, more trusted banks that they consider to be safer, USB included. In fact, in the earnings report, it showed a dramatic increase to their average total deposits. And while the economy is looking really bad right now, the higher interest rates have actually boosted their interest income, which when coupled with the growing deposits, USB was able to beat expectations on both the top and bottom line. And in a market where size is implied as safety and strength, well, I believe that the recent acquisition of Union Bank should only bolster that image even further, which is also helping them grow revenues by a staggering close to 17% this year. And yet, despite all these positives, the stock has actually been crashing into the ground even after those strong earnings. This is partly due to a short seller report from analysts at Holdco Asset Management that claims US Bank doesn't have adequate levels of capital to survive the current environment and stricter regulations that will come from the Fed, in large part because of that big purchase of Union Bank. And it will therefore need to raise capital and cut their dividend if things get worse. USB has responded to these claims, though, and completely dismissed them, saying that the Union Bank purchase will actually result in more capital over time and that they feel well positioned to survive any stress tests from the Fed and the current environment, also noting that they fully expect to continue growing their dividend and have only paused share buybacks temporarily because of the current environment, which is something, by the way, that practically all banks are doing right now just to be safe. It's just like a safety measure. And while the short seller report certainly does raise concerns, it should be noted that most other analysts seem to not agree with them, as the current stock price of USB is also well below even the most bearish targets on Yahoo Finance, just like Walgreens stock. I think it's also worth noting that the short seller has likely already benefited from the declining stock price, as it's already fallen by over 30% this year and is now trading at the lowest levels we've seen in over a decade, which coincidentally has left them not only 30% cheaper than the sector on a PEG basis, despite their superior size as the 5th largest bank, but it's also left them with just about the biggest dividend in their history at almost a 6.5% yield, and some fantastic growth metrics to go along with it, like over a decade of growth, a double-digit growth rate, and still a pretty good payout ratio of about 50%. This one I do consider to be riskier than Walgreens, because if we do go into a recession, especially a very large one, then banks, financial stocks, those get hurt quite a bit harder than other stocks out there. And we know that during the Great Recession, I believe like all banks cut their dividends, so the risk of a dividend cut is definitely there too. Longer term, I'm still very optimistic about US Bank, and so that's why I'm buying the stock. It's just too cheap right now. It's hard for me to ignore it. I'm kind of thinking about it longer term, but there is risks there. So I'm buying it in small amounts slowly over time. Don't want to get overly exposed to it, but it is a stock that I am picking up. That's going to leave us now with the highest risk stock of the month that we're going to talk about. And you want to talk about risk here. Not only are we staying in the financial sector, we're actually going to move over into speculative fintech territory, and that's going to be SoFi, ticker symbol SOFI, which it just so happens that they just recently released their earnings report this past week, and the stock crashed even more. But in my opinion, it was a bit of an overreaction, so I'm actually buying a little more of the stock myself because of it. Now, when looking at that stock, you can see that they actually had a really strong start to the year before slowly giving back those gains throughout recent months. So I feel like it really does want to take off, but it's being kind of held back. And then, of course, it fell off a cliff here this past week after reporting earnings, which leaves them now almost flat for the year. And that's kind of where my position is too. I'm only up a couple percent on mine. But zooming in here, we can see that Monday and Tuesday of this past week was where they fell by over 20% in just those 2 days alone, really giving up all those earlier gains of the year. And that was following their earnings report. And yet, I was actually very impressed by their earnings report. Not only are they really close to reaching GAAP profitability with only a 4-cent loss on EPS, which I do think they will very likely turn that positive this year, but they also beat analyst expectations of those EPS by a monstrous nearly 50%, while also beating on sales by over 5%. And year over year, they saw revenue growth of over 46%, net income growth of almost 70%, profit margin growth of almost 80%, and even an increase to their cash position of over 20%. And they even raised their full year guidance too. And yet the stock actually got destroyed following that report. So what exactly happened? Well, in my opinion, this is a combination of elevated fear in the financial sector from that SVB collapse, as well as the weakening economy and SoFi's heavy exposure to it. I don't know if any of you missed this, but the Fed recently raised rates again this past week in what has been one of the fastest rate growing environments that we've ever seen. And the last time that this happened, we spun into the Great Recession. So the fear is that another recession could be just right around the corner. Well, the reason why this scares SoFi investors is because SoFi has been leaning more heavily on personal loans these past couple years, shifting away from student loans, which they cut in half, while personal loans have more than tripled. And the fear is that SoFi likes to sell these loans on the secondary market after collecting interest from them. But if a recession hits, then investors may not want to pick those up, thus lowering demand for them, which could result in SoFi being stuck with some bad loans that consumers are also struggling to pay back. Of course, this is a problem that just about any bank or financial institution has to deal with during a recession, but considering SoFi is not even GAAP profitable yet, they tend to get hit much harder. Still, there are many reasons to be optimistic about the longer-term future of them. SoFi has a disruptive and robust platform that can handle most financial needs for consumers and has continued to grow their user counts by a staggering amount every year. And while sales growth is dipping down right now because of the environment, it's still pretty high at around 30% growth, and that's coming off of already very strong performance. The valuation is also not too bad at a price-to-sales ratio of only around 25% more expensive than the sector, but keep in mind their profits are also soaring, which will help that valuation come down over time. Not only have they already been profitable for the past couple years on an adjusted EBITDA basis, but they're also expecting to do literally hundreds of millions of dollars this year. Just a little while ago, they were negative. Now they're doing hundreds of millions of dollars on EBITDA, while they're also growing their EPS by close to 200% on average expected over the next 5 years. That's according to analyst estimates. So considering the stock is down over 85% from its post-IPO highs, I'm just wanting to add a little more of this spec stock slowly in small amounts over time. It's a spec stock and it's in the financial sector at a time when we might already be in a recession. So to think that this stock is not going to be volatile, to think that it can't crash or that you have a guarantee that you will not lose money on this stock is delusional. This is a very high-risk speculative stock, and I believe that it should be treated as such. At least that's how I'm treating it. I don't consider it a safe investment. It's more of a speculative play. I just feel that over the longer term, they have so much potential that I feel like 5 to 10 years out from now, I might look back at today's prices and feel like I got an absolute steal on it. We'll see. It's high risk, potentially also high reward. I treat it as a spec stock, buying in small amounts, don't want to get overly exposed to it. Small amounts slowly over time. That's how I feel about it. But I'd love to hear what you guys think. How do you feel about any of the stocks we talked about today? Drop your comments down below. I'd love to read and respond to them. Let me know if there's any stocks you're buying or selling. And thank you so much for all the support. Thank you for watching the video. Please hit the like button. Please subscribe. And if you want to support the channel even further, you can go above and beyond and click on the Patreon link down in the description. You can sign up. You can also sign up for our channel's Discord, which is an awesome place where we get to chat together about stocks and a lot of other stuff. And it's so much fun. We've been having a blast on there. So if you do want to join that, click that Patreon link down below if you'd like. But either way, regardless, thank you for everything you guys do, all the support. I hope you're all doing well. And I will catch you in the next video, my friends. Take care, everybody. Bye-bye.